Okay, we'll go ahead and get started. So before I introduce our next speaker, I just want to welcome everyone to week 4 of the Elevate AEC experience. We've got a big day planned for you today. Before we get started, just want to point your attention down to the Q&A box down there, the little icon. You can click on that. We want to use the Q&A for questions for our speaker today versus chat. So if you have any questions for Bill, please use that Q&A box and he will address those as he can throughout the presentation. So I'm delighted to kick off today's headlight keynote speaker, Bill McConnell, who is the co-founder and CEO of the Vertex Companies. They are a 600-person employee-owned AEC firm that offers engineering, forensic, construction, environmental, and digital solutions throughout the globe. On average, Vertex has grown an average annual rate of 20+% for the past 25 years. That's impressive. Bill has undergraduate and graduate engineering degrees along with a law degree and is working towards a PhD in civil engineering through Vertex's partnership with the University of Colorado. He's also a licensed engineer in approximately 25 plus states. So I will hand it over to Bill McConnell. Thank you for being here, Bill.
Chad, thank you for having me. It's an honor to present in front of this great audience today and talk about embracing the chaos, how AEC firms can be both offensive and defensive during recessionary cycles. Let me see here. So to say the very least, it's been an exhausting year. We've had civil unrest, we have an election year, we have COVID, of course, and a follow-on recession. We've come to the close of an 11-year bull run. We were in a late expansion cycle for the past several years. And it's been tiring, but wait. In the midst of chaos, there's opportunity, and that's what we're going to talk about today. How AE firms can really position themselves and take market share during recessionary cycles and early expansion cycles. A lot of what I'm going to be talking about for the first, I would say, half of the presentation is just face the brutal facts. What is the data? What does it say? And then we're going to talk about some suggestions on how AEC firms can really do well in these market cycles. Few opening points. Pandemics are nothing new. There's been 4 pandemics over the last 102 years. By far the worst was the pandemic of 18, which approximately 1/3 of the world's population, which was 1.8 million at the time, contracted the Spanish flu. And in terms of the US, the death toll was 675,000. So it was approximately 3 times that of the current pandemic. In 57 and 58, the pandemic was fairly severe as well. Worldwide death toll was about 1.4. In the US, it was about 120. Similar numbers for the 68 pandemic, and that was about a million. Worldwide death toll about 1.1 million, about just over 100,000 here in the US. And then most recently, the H1N1 pandemic was much milder when compared to the current pandemic in the past 3. The death toll in the US was only about 12,000. So what happened during all these pandemics? Well, they were all accompanied by recessions. The 2009 pandemic, there was already a recession in play, so it didn't really trigger a recession. But for the others, there were recessionary cycles between 6 months and a year. March 12th, 2020, we came to the end of an 11-year bull market, the longest bull market run on record. So typically a bull market is about 5 years. The traditional, over the past 70 years, they've been about 5 years long. And then they're followed by a bear market, which on average is about 10 months long. So combined, it's really a 6-year economic cycle. And there's been approximately 11 bull markets over the past, since 1950. So for the past 70 or so years. And bear markets always trigger recessions. The only bear market that didn't trigger a recession was in the early 90s. Believe it or not, the early 90s recession actually was a bull market throughout. So what is a bull market and what's a bear market? Well, it's basically a 20% movement in the equities market. So a bull market's when there's a 20% increase from a low, and a bear market is when there's a 20% decrease. So bear markets equate to pessimism, bull markets equate to optimism. And what's incredibly interesting is the bear market that we faced in February and March of this year was the shortest bear market on record. It was approximately 1 month long. Again, the average bear market was about 10 months long, 9.5 to 10 months long. And this was 30 days. It was crazy what happened. There was an instant correction of about 35%, and then there's been a boom of about 60%. So when you look at the bull markets since 32, the average, when you average these out, again, it's about 5.2 years on average. And then you see the March 09 bull market went for 131 months, which was longer than the October of 1990 bull run. So really, the 2010s were one big bull market. The growth of the S&P was 400% less than the 417 in 1990, but it was still an amazing run. It was slower growth in the early years of the 2010s, and then it really picked up in 2017 and flourished through 2019. Really, we're in such late market at that point in time. The first 2 quarters of 2019 were actually very slow. It looked very much like we were moving into a bear market and moving into a recession. But then the FOMC lowered the Fed funds rate several times, and that triggered, prevented a bear market and triggered an expansion for Q3 and 4 of 2019. And then we had the COVID pandemic that really started in January and really affected the downturn in mid-February through March. So here we have it. February 19th, there was a record high of the S&P 500. And 30 days later, the market dropped by 34%. Keep in mind that on an average bear market, there's a drop of about 35%. So this was a traditional bear market drop, but it was such a steep decline. We haven't seen a decline like that in any other previous bear markets. And a lot of that was self-imposed shutdowns. And we haven't had a major pandemic since the 60s. So a lot of industry and government had forgot how to handle these things. And now we're prepared. Social distancing is acceptable. The hospitals are prepared, and we have testing like no other country. So we're in a much better position, even if there is another spike, a third spike, if you will, in the US, which appears to be happening right now. But since March 23rd, the market has just ripped. It's up 60% since then, and it hit record highs in September. And here's my math right here. So from February to March, there was a 34% drop, again, a traditional bear market drop. And since then, well, I guess as of mid-September, there was a little dip after that, but now it's back up. The market's rebounded by 60% in 4 months. It was an amazing, amazing rebound. And what that signals is a quick recession. Recessions are normally between 6 months and 2 years. Does that mean this is going to be on the quicker side? Well, that largely depends on, number one, the vaccine, and number two, is there going to be another spike here in the US? And again, that trend line suggests that's the case. So, as I mentioned, there's been 11 recessions since 1950, 11 recessions and 11 bull markets. Average recession / bull market occurs every, I think I said 5.2, it's 5.82 years. So it happens all the time. However, the FOMC changed their monetary policy in the early 90s, and they've really been able to control recessionary cycles and lengthen them out based on Fed funds rate. So that didn't necessarily happen in the 2000s because we had two recessions, one mild and one extremely severe. But we also had two bull runs of 10 years. So it's been quite a run since the 1990s. And that's really kind of affected cycles somewhat. We'll talk about that. So I want to review the AEC economic cycle, this 6-year run, 6 to 5, let's say 5 to 7 year one. What does that consist of? Well, impact, well, there's 4 components of a typical AEC economic cycle. You have your recession, which we're in right now. Then you have early expansion, mid expansion, and late expansion. And they all mean very different things. So in terms of analyzing where your company is at, it's critical to know where you stand and what's coming in order to make sound decisions moving forward. So typical impacts of a recession are shrinking backlog. And that is by far the biggest impact. And that causes really bad decision making. There's scramble for work, there's a scramble for utility. And some of the prudent measures that companies often take are balance sheet management, watching out for cash. And the opportunity is really, it switches from a seller's market to a buyer's market in terms of M&A. And we'll get into that a little later. And then the next phase, which is the most deadly phase for AEC companies, is the early expansion period. When you look at the statistics for construction companies and AE firms, the fallout occurs in the early expansion period. So that would be 2010 to 2013 in this last expansion cycle. So there's peak company fallout, there's peak risk, and the opportunities are, there can be an opportunity for a market share grab, and it's really a key strategic period. It's an M&A period and a great period to invest in growth because you know right behind this early expansion is going to be a nice mid expansion, and then you get into the late expansion. In terms of mid expansion, everything's great, surging revenue, surging margins. The unemployment rate is not at 3%. These are growth years organically and through M&A. And then in terms of late expansion, that's when you see the escalation because of the labor shortage, and it's a seller's market. So the only way to grow in those years is really M&A growth because you can't hire enough people because they don't exist. In this last 2010 cycle, we had unemployment that dropped down to historic lows of 3 to 3.5%. And there's just no one available to grow organically, which forces an overemphasis on M&A, and M&A valuations in turn escalate both in multiples, and you have high EBITDA, you have peaking EBITDA in your mid and late expansion cycles. But you have margins that do actually settle down in late expansion because you do, with the escalation, you have that margin either flattening or reduction. And because of the escalation, that's when spending eases, development eases, and that's when you see us enter recession. That's when you see bear market. That's when there's a flight to safety in terms of equities. People are looking downstream, they like what they see, and they go to fixed markets, and they go to the bonds, and all of a sudden, bonds become cheap. There's an inverted yield curve, which we'll talk about, and then, hey, you're in a recession. But I gotta say, the late expansion cycle for this last cycle was about 4 years. So you don't know if it's going to be 6 months or 4 years. So you really don't want to hunker down for 4 years. You just need to watch it. You need to watch your CapEx, etc. So in terms of the US economy, obviously, the biggest impact is the pandemic. 40 million worldwide cases as of the 19th. US cases are 8.5 million. What's very interesting when you compare the US versus other countries throughout the world is the active case count. Our active case count is 2.7 million. It doesn't tick down, and I don't know what's going on at the state level, But in all others, including India, who's had really the same amount of cases for the past month or two than the US, they only have 700,000 active cases. And if this is a 14-day cycle, those simply aren't being reduced. So I don't know if that's overstated or not. But the average case count is about, it's 50,000, 60,000 yesterday. And you see these three peaks. The first peak was the early states, Washington, New York, New England, where they got hit hardest. And then you had this second peak where you had Florida, Texas, California really get hit hard. And now this third peak is really kids going back to school. And how long is that going to be now that everything's moving indoors versus outdoors? Is that going to cause a spike? We'll see. But again, if there's a stimulus number 2 package, PPP money, really held us on until about a month ago. If there's a second stimulus package, which there will be, that'll more or less be a bridge to a vaccine, and the vaccines are a couple months out, probably 0 to 6 months out. So that's important news there. This recession has been the most severe recession in the last 90 years. Here we are with unemployment. Look at that spike up to 15%. We haven't seen the likes of that since 1938, right after the Great Recession. There was a significant recession in the late 30s, but we just don't see unemployment that high. But typically unemployment peaks after a recession. So it trends up through the recession and then it peaks. As you can see back to the 50s, that has always been the case. But here we peaked about 5 minutes into the recession. So it's an interesting statistic. Again, a lot of that is explainable because there was a self-induced shutdown. And now the unemployment rate has been cut in half. So that's obviously a good sign. And another good sign is that, well, that's probably going to level off somewhat, and it may even spike up a bit based on what we're hearing with this third COVID spike, lack of stimulus. So this just shows the severity of the current recession. And then real GDP percentage, typically during the Great Recession, GDP dropped by 5%. Quarter over quarter, we're seeing drops between 30 and 35%. Again, this is the most severe GDP drop since 1945. Now, this is quarter to quarter. When you look at annual numbers, it's about 10%, 10.1% to be exact, based on Fed data, Federal Reserve economic data. And then here is a graph of that GDP drop. That's the 10% drop we saw in GDP, which went from 19.2 trillion to 17.1 trillion. It was a big drop, and it caused a 10.1 drop. And when you compare that to other recessionary cycles, it is extremely, extremely severe. So where do we stand? When you look at the last recessions, they go from 6 months to a year and a half. We're 8 months in. You really don't know when a recession stops because the Fed looks back at data and tells you when it stops. So a lot of times it feels like you're in a recession for longer than you actually are. But all indicators suggest that we have a bull market right now. There's optimism. We have banks that are lending, unlike 08. Fundamentals are fairly strong. So this will likely be not a year and a half recession. In terms of the GDP decline, we don't know what the peak to trough is, but when you look at that 5.1 in 08, we're already at 10.1. So it's extreme. It's very extreme in terms of GDP. There is a current bounce back though. So election years, how does that affect our marketplace? Well, in terms of equities, there's actually been an 11.3% return during election years, which is odd. That's the average return is about 7.3%. So it's almost double the average return. In these highlighted years, those are all recessionary years. In 1980, I realized it says it's market jumped by 32%. That's because the recession was 6 months and ceased 6 months into the year. So there was a big rebound in the second half of the year. But you can see really there's only losses during the recessionary cycles. Now here we are in a recessionary cycle and we're actually up for the year. So is that going to be like 1960 and 1980? Perhaps. So why is the stock market jumping? Again, it's today versus tomorrow. When you look at tomorrow and you have optimism, the market's running at least 3 months ahead. So they're saying tomorrow is going to be a brighter day, whereas recession is today. It's what's the unemployment rate? What's the GDP? How does it compare versus yesterday? So it's a today measurement versus a tomorrow measurement. And again, when there's optimism, there's a bull market. When there's pessimism, there's a bear market. And that's why you see in late bull markets, you see pessimism because you have inflation, things are slowing, and you have labor and material costs are increasing. And that's when you see the bear market pessimism. And here is the CPI. So things get cheaper during recessions. This recession is no different. When you look back, you see through the recessionary cycle, you usually see a drop. Again, you don't see this steep of a drop so immediate. It should be interesting to see how things move forward, especially with housing doing so well and some other major sectors doing quite well. Yield curve. Again, this is when the outlook is negative, you have an inversion because there's a flight to safety. Investors go and invest in bonds, long-term bonds. And because there's so much demand for long-term bonds, the returns are reduced. And the 10-year return is actually less than the 2-year return. And that's when there's an inversion. And what does this mean? Well, this means that there's a recession coming. There's never not been a recession after a yield curve inversion. Who would have thought about a pandemic? But we were headed towards a recession regardless. We were so late cycle. This was just a quick trigger. And it's basically a restart button. And then we have the federal funds rate. During recessions, it's a stimulus measure by the FOMC, and Fed funds rate drop quickly. And that's a tool that the feds use to stimulate spending. And that's what we have here. In 16, they ticked up the Fed funds rate 9 times, and then they've dropped it, drastic drops several times, March being the most recent, down to 0. So again, whereas in 08, we had a situation where we had 0 interest rates, but we had big fundamental issues with commercial banks and investment banks. So there wasn't that, the stimulus really had no effect because firms like GE Capital and you had that were tied by federal regulations. In addition, almost all the investment bankers were tied up. And so there wasn't lending. And that's why it took so long to figure out how to respond and how to grow out of the 08 recession. Here, we don't have that problem. So I see private development really coming back in earnest next year and trending up for the next several years. Here's the biggest problem we have as a country, and no one mentions it ever. Our debt level is 140% of our GDP. So yeah, just let's see here. In 1990, it was 60%. So it's more than doubled over the last 20 years. That's a big problem. That's basically was Greece's problem. It's a balance sheet issue that the country has. Stimulus 2 is going to make this even worse. So eventually there's going to be it's going to have to be addressed. Now, what does this affect? Public construction. Public construction has been flat as a pancake for the past 10 plus years because there's no money at the federal level. We haven't seen an infrastructure bill being passed, and there's high demand for new bridges, new roads, new treatment plants, and it's just going to have to be a higher priority. And if there is a blue wave, there'll likely be an infrastructure bill that's passed in short order, which will help stimulate the public sector. And the public sector work is usually a safe haven during a recessionary cycle. It's very steady, and that's what gets funded. It's not a high growth sector, but it's a safe sector. And this gives me solace because Germany, they only had 82% debt to GDP, but they've reduced that to 59% over the last decade. Russia in '99 was at 92%, and they've got it all the way down to almost roughly 10%. So you have countries that within 10 years can really reduce GDP. I don't know what that looks like on the federal spending level, but this, again, is encouraging. So takeaways, just for the kind of quick economic review. Bear markets typically occur every 6 years, must be a consideration in business planning. The 20 recession was the most severe, but it's probably going to be short. If we have a third wave of the pandemic here in the US, that might slow things a bit. But the Fed funds rate is 0 and banks are willing to lend. So it's just developers that are willing to spend money. And the housing market is booming because of the low interest rates. And stimulus 2 will be a bridge to the vaccine. So in terms of the AE industry and how it performs, what you really need to look at is US Census Bureau data. And they use the NAICS classification, it's pronounced NAICS. And that classification classifies architects, engineers, and related services. It's NAICS code 5413, construction's 23. And the data lags 3 years behind, but that doesn't matter because we want to see how do things go during recessions. Here are the subsets. By far, the 2 largest subsets of architectural engineering and related services are the first one, architectural services, and the third one, engineering services. They make up about 70% of all of those companies. So we have 94,000 firms, AE firms, in the country. And take a look at that 500 plus. Only less than 1% are large, or above that 500 mark. And it's an incredibly fragmented sector beyond that. You have 84,000 firms that are 20 and less. So again, it's big and really small. And so when you look at this is the total number of firms. If you take a look, we were at 100,000 back in '07. If you look at today's data, we're up at 100 now, but in 2017, it was 94, and it's finally trended back up to where we were. But what this suggests to you is this is not a growth industry. When you look at software and you look back during this time frame, there's been I think it's from 70,000 to 130,000 companies, massive growth in that sector. Not so much in AE, it's very traditional, it's old school, it's mature. And the larger firms, as you can see in the orange, 500 plus, actually does quite well through recessions. It's fairly steady. And as you go up to smaller firms, it becomes very volatile. And here's how they performed, how has these AE firms performed during the 07-09 recession. Well, we had a fallout of 8,200 firms, almost 10% of the firms, smaller firms, had fallout. And then since then, there's only been a birth of 1,800. So I should say through 17. So there was a real long dip, and it took a long time to start building that back up. But in terms of the larger firms, we have 63 larger firms, and then 144 have been added. So the big are getting bigger and the small are getting smaller. The big's gobbling up the small. When you look at the 2000 to 2002 bear market, really it was very little impact. I mean, you still had fallout of 1,800 firms that are smaller firms, but it wasn't a severe impact like the 08, like the Great Recession was. The workforce, similar type of trend, very flat. There's about 1.5 million architects and engineers in our industry right now, fairly mature. There's a high demand for more, There's been very flat curve in terms of architects, fairly steep curve in terms of engineers entering the market, which is surprising. And here it is. In terms of the AE workforce, orange is big, 500 plus. You see them growing very swiftly, whereas the smaller firms are just trying to catch up to where they were from 07 to 17. And then employment. So you have 0.8% of the firms are 500 plus, and they employ 43% of the market. So almost half of all workers, AE workers, work for larger companies. And then you have 20%, you know, 84,000 companies employing only 20%. About 80% of all companies, if not more, fall into that less than 20%. So it's a real inverse ratio there. And in terms of payroll, while employment is 43%, payroll is 47%. So the larger companies are actually paying more. And what does this all tell you? There's big opportunity on the big side. They're better capitalized, they're more diverse, so they do better through recessionary cycles. So the question is, how do you grow? And then we have number of employees through recessions. Again, you have the peak to trough drop in the Great Recession was only 5.2%. And then since then, there's been a boom with the larger firms, as we saw in those graphs. So now let's just take a look at architectural firms versus engineering firms. So out of the 92,000, about 67,000 are either predominantly architectural shops or predominantly engineering shops. And so it's 67,000 out of the 94,000. Let's take a look at their performance. Again, boy, that's a real growth industry right there. It's flat as a pancake. It's a mature industry. So really it's about gaining market share through M&A and trying to take away work from our competition. It's extremely mature. And in terms of performance, architectural shops got really smoked in the 08 recession. There was a 18% drop, 18% fallout. So you had almost 5,000 companies fall out, and through 17, only 1,000 came back. So it has not been a growth industry. Engineering fared a little better. And why is that? Well, engineering really relates to public works. It relates to both, but there's more of a market share in public works, where the engineer has the contract with the owner. So that's why, again, it's a little more stable through recessionary cycles. We only saw a drop of 5%. And of the 2,000 companies that fell out during that 08 cycle, you had 1,400 that have come back, and then it surpassed that over the last couple of years. But again, that data is not finalized. And then the employment breakdown, you have engineering firms. Look at that kind of steeper slope on the engineering side. There's been a little more growth on that. And the reason for that is public works has come back over the last couple of years. So we see a spike right there where architectural growth is pretty flat. And again, in terms of number of employees, 30% fallout in employees during the Great Recession versus 8%. And then they've actually both had, employee count-wise, both had a similar increase since then. And then in terms of payroll, it looks like the engineers are making a little bit more money and they're getting raises. Is this a good thing? Not when this outpaces your revenue, because what that means is inflation. And that's what we saw over the in 2017 to 19, we saw a lot of inflation. There's no overall unemployment was 3.5%, but engineers, it was more or less negative. So pay went way up, shrinking margin, and then you fall into a recession. So let's quickly look at the construction industry. And this is a lot of data, I understand. Let's see, we have a question here. What's the outlook for architects doing business with municipalities, commercial and developers, or residential? Residential is going to be back. We're going to look at some of those numbers now. In terms of municipalities and commercial, is there going to be building projects? I would think that infrastructure work is going to be more weighted in this return. But if there's public-private partnerships, then that'll loop in architects for building projects. So I would say it's mixed. I'm more bullish on engineers doing a little bit better through this recession, because they typically do, because they have that infrastructure background. So we'll get into that a bit. Look at this volatility. Construction is extremely volatile, and that's because 2/3 of construction, more than 2/3 of construction, is private. Blue is private construction, private residential construction. Orange is private non-residential construction. And then gray is the public works. So again, you can see public construction pretty steady. And then you have these massive overcorrections in both directions on private work. The work goes crazy, and then there's a recession, and then nothing happens, and then it builds back up during a bull market, then it crashes. And we saw this really exacerbated in 2008, when nothing happened for several years. Residential went from 700 billion down to a couple hundred billion. There was just a massive correction there. And the exact opposite trend exists. So when you compare construction firms versus AE firms, you have a similar number of very few firms that are large, but the smaller firms, there's more smaller firms, and they employ basically everyone. So, which is what you would expect, because this includes subcontractors in addition to GCs and construction management firms and civil firms. And so again, the large firms have been a lot more steady than the smaller firms, more diverse work, service areas do a little bit better during downturns. Construction employment, it went from almost 8 million down to 5.5 billion. So between 2 and 2.5 million workers, about 25% of the workforce dropped out. And it finally caught back up in 2020. But keep in mind, there was a lot more work being performed in 2019 and 2020. So it was a big overcorrection. And then there's the industry has been desperate for workers for several years. By headcount, here you go. Orange is, or blue is less than 20. So the smaller firms have all the people in construction. And execs believe that the downturn will continue until late 21. Well, why is that? We have a bear market, or we had a short bear market. We got a bull market right now. Should they be more optimistic? The answer is no, because in every instance, the biggest problems occur for AEC after the recession in the early expansion period. It doesn't happen during the recession. All that happens during recession is you burn your backlog, and then you have to chase and scramble for your new backlog thereafter. So that's why there's pessimism in construction. And again, this is that same article from E&R where it says contractors are scrambling for new opportunities now, and they're looking for ways to be more efficient. E&R confidence index is an all-time low. You would anticipate that the sectors that are low, commercial office, entertainment, hotels, retail, oil and gas. Index, all-time low. You have ABC's index is the lowest since 2012. They've been maintaining this index for quite a while now. And the architectural billing index, all-time low. It dipped down below 30, believe it or not, where 50 is really an increase. Below 50 is a decrease in billings. And so this is very notable that billings are decreasing as worklog is getting burned off. And this is just the last couple months from AIA. Architectural firm billings still show little signs of improvement. The clients are reluctant to move ahead with new projects. Here's an article, AEC proposal activity is all-time low. Restaurants, hotels, of course, office buildings, retail are at the high end of that. So, okay, well, it's so bad. Let's take a look at the numbers. Believe it or not, the construction industry is up 2.5 this year. So again, it does 1 year. And just keep in mind, this is August 19 to August 2020. The first half of 2019 was really bad. And there was really a jump in 2020, in late 19. So now we have private construction spending that is getting decimated. So public construction is really holding its own. And what is propping, how is private construction still up by 1.5 points? Residential. Residential's hot, you get the low rates, people are spending more time at home. So that's why we have this jump, considerable jump in the largest sector of all construction, which is about 600 billion of the $1.4 trillion sector. And you see these sectors, lodging, office, and others, are really compressing largely at this point. And why is the housing market so hot? The largest sector in construction? Well, again, you have a fundamental shift. Everyone wants a home office, and you have zero interest rates. And there's demand, and there's banks that are willing to lend. So that'll likely continue. Public construction, again, it's fairly stable. Look how it increased through the recession. Then it flattened out because here's public construction spending. Residential, which is actually a small sector, is up big. Public safety, as you would expect, is way up, and that's a smaller sector. But you have highway and street, which is a very large sector. They're all whole industry is getting shocked right now, and water supply up 26%. So overall, the industry is up 5.5% in spending. So it's having a very, very good year. Construction establishments. Look at that trough in 2013. So what happens is, it's not the recession that causes the problem. You burn backlog, you make bad decisions, you chase work, and then there's fallout 2 to 3 years later. And we see this in every statistic available for the construction industry. So in 2019, there was a labor shortage, there was record revenue, and that led to schedule issues and quality issues on a lot of construction projects, as you all know. And now we have backlog reductions and scrambling. And what that equals is usually, with this increased competition for less work, shrinking margins and decays that occur downstream. Because once companies take on bad work, they have to prosecute the work, and then the financial troubles begin in the back half of those projects. Contract surety losses. The surety industry bonds predominantly public construction contractors and some private contractors. And you can see loss ratios peak in 2012 here after the 07 to 09 recession. So again, you have that 3-year lag before the biggest problems occur. So embracing the chaos, what do? So the best plan is to build a defensive, non-cyclical book of business. The problem is, you can't do this overnight. This is something that you need to work into your business plan, and it takes several years. After the 2000 to 2002 bear market and recession, we made a point at Vertex to really step back and say, we need a defensive book of business so we can couple it with our transactional business. And on the environmental products, we have some cyclical products. And on our design side, we have some cyclical products. So we built a more defensive book, and it took us several years, and that really helped through 08. But again, it's very hard to do that overnight. It's something to consider moving forward. And the most common fix is really right-sizing management, salaries, and increase profit sharing depending on performance. Those are all prudent measures if you're in a transactional market, if you're focused on private construction, commercial office or retail, and that's being hit really hard, well, you're going to have to make some tough decisions. And the modern thinking is let's embrace tech efficiencies to lower back office costs. While there are softwares out there and tech advances that certainly help that, I don't know if it's really translated into a dollar for dollar savings. That's we'll figure that out in a couple of years from now, but obviously you do want to maximize efficiency with the tools that are out there. And then the other thing is important to realize is that this is short term. This is recessions are 6 months to a year and a half. It's probably not going to be a year and a half in this instance. So investing in sales and marketing to bring on good backlog over the next early expansion cycle. Personally, we see the most opportunity in early expansion cycles, and we'll talk about that in a second. And inaction is the riskiest response. Rash action is obviously almost nearly damaging, but having a plan, and I'm sure all of you had a plan for this recession. We had Operation Endurance at Vertex. We got together in February, set forth a plan, and it really, we had very little impact, fortunately, because of our defensive book, because we took that kind of longer term vision and twisted that. And the other thing is be defensive and offensive. If you can cut costs, if you can make some balance sheet improvements and promote sales and marketing, and take advantage of the M&A market right now. We have a seller's market going to a buyer's market. Why is that? Because you have typically valuation as a multiple of EBIT or EBITDA, and multiples they were at record highs, they're going to ease, and then you have EBITDA that's going to be shrinking for our entire industry, and that creates better value when you understand that through a market cycle, there will be improvement. Is there going to be another 11-year bull run? Probably not, but it's something that is just, you need to understand that 2021 and 22, and even the tail end of 20, it's the opportunity of a decade. It's time to make hay. Now, the question is, do you have the adequate capital? So in this whole strategy component is, why are the big getting bigger? Well, they have capital and they're diverse. And that business, and they have arbitrage multiples. They're valued at a higher multiple than smaller companies with like one discipline shops with 10 people. So they have a lot going for them, and they can take advantage of that arbitrage. And they have capital. And this is a typical large firm. So, like I said, seller's market to a buyer's market. That's a big opportunity. Is there going to be capital to make those moves? Partnering together and forming larger companies. That's a good move because larger companies do very well during downturns. We were Vertex was in really a tweener mode for the past 5 or 6 years until we kind of eclipsed that 500 mark. Now we're one of those that are diverse, that do well through recessions and really have very little impact. And so, partnering and figuring out how to be multidisciplined is key. And Zweig group has been very important to us in helping us grow, and they're a great source to tap into. So and my last slide of the day is basically AE leaders who are on this call right now. You earn your money during recessions and during early bull markets. Anyone can run a division or a group during a mid to late cycle period. There's plenty of work and not enough companies to do the work, but it's during the next year or two, getting through the recession and then getting through early bull market is when you really have to earn your keep. And understanding the past, which is what I kind of went through in a very, very short order, I think is important. And that helps you make decisions, sound decisions moving forward. Are any two recessions the same? No. But understanding the cycles and the typical lengths and the typical drops in a bear market of 30%, and it's going to be, 6 months to a year and a half likely having the problem. And then it's like, let's get through this early expansion cycle, and then we're going to be off and running. With that in mind, with that history in mind, you can make sound decisions moving forward. And that really helps with confidence. And it helps to be objective when you look at the numbers and you say, okay, well, that makes sense. You look at all those confidence index that are all-time lows. Well, no kidding, because backlogs are being chewed up. It's been so long since a recession. Typically, there would have been a recession in 16. But people may have forgot what it's like. And being objective, understanding this process, understanding the Fed's done what they can do. Yes, pandemics are rare. Yes, we haven't seen a major pandemic since the 60s. And this pandemic is not as bad as 1918, but it's the worst one since then. But the country's got this pretty much under control in terms of hospital beds, in terms of testing, and in terms of an acceptance of social distancing. So when things spring back, it'll be a pretty nice springboard for this next bull market that we're already in. We're 4 months into a bull market, but when are we going to be out of the recession? And then be tenacious. It's just in terms of earning your money, it's working hard. Now's the time to work harder than ever, to support your folks, to support your people, to look out for opportunities, to see if 1 + 1 = 3 in M&A activity. Because if 1 + 1 = 3, then it's a great investment for everyone and everyone's happy. And then there's going to be a flywheel growth objective. And the other thing is, based on all of this statistics, that's one of our core cultures is growth. Because when you look at the numbers, if you're going to maximize shareholder value and our employee value, we need to keep raising the ceiling. We need additional opportunity, but we also want to be worth more. That's important for our return to our shareholders. So it's something to be, a lot of times you get lost in the work and the daily production. But if you keep this in mind, again, it may help with decision-making. And that is it for my presentation. I've got a quick question here. Let's see, looking at the material cost, wood has skyrocketed while some metals have stabilized or declined in demand. What's your take on material costs and how estimators can project these costs out over the next 18 months? Absolutely. It's so funny when you look at where's housing going and where's this residential market going. It's such a massive market. It's $600 billion. And so when there's a spike in resi work, obviously it's single family and some multifamily is wood construction. You see an instant spike in costs. Where is that going? I don't think we're not in a subprime lending situation. I think the lending covenants are in check. Banks are in good shape, although banks aren't valued at anything. They're in good shape. We'll likely see a steady rise in this. So there's probably, I wouldn't see much deflation in wood products and drywall products. What you will see is, oil and gas products. WTI went down to 20. It was basically at 1998 levels. Now it's jumped back to 30. But other products are, you're seeing deflation in a lot of other non-residential products. So that would be heavy highway, which is a lot of petroleum-based products, and commercial, non-residential sectors. And lowering salaries is not a good idea. It hits you back. Better to get rid of unproductive people. That's a question that's posed. I think unproductive people don't belong in your respective companies. You want to have people that add value at all times. If you do have a team of folks, I think first line of order, yes. If there's Lisa on over at Tetra Tech often told us, you need to prune the trees sometimes, because if you're a team working together, obviously you want A and B players, and you don't want C players dragging down your A and B players. But if that wouldn't apply in terms of cutting salaries, it mainly applies for executive level folks is when you see the cutting of salaries and taking a pause and going from there. But that's a very good point, and it's worth mentioning. And let's see. Zweig is reporting record profits from firms. I understand it's looking at last year. How do you reconcile that with the margin compression that you referenced? Yeah, so the margin compression is basically what happens in late cycle is either margin flattening, which you do see from industry data, is margin flattening in 19 and 20. And it is, that's my explanation there. You don't see a big jump. Maybe Zweig does have data that shows a jump, but late cycle, it's usually, you're bringing on a, so you may be growing the top line, but again, your labor is expensive. And oftentimes there's problem projects that get incorporated because of delays and workforce shortages. So that's what I've seen based on this Census Bureau data is a little bit of a squeeze in profits in late cycle. And that's what we anticipate. But you do see, obviously during the recession, it's not a bad thing because, and you got to couple that too with this current recession. A lot of expenses have been eliminated. Vertex spent millions and millions on travel, and that's down to virtually zero. So we are getting the benefit that, but what's the long-term effect? Are your relationships with your clients, are they getting stale? Do you need to be on the road? And it's a little bit of a balancing act. I think there was some unnecessary expenses being incurred when I look back in hindsight, but it is important to stay in front of your client base and those that give you work. What environmental consulting service sectors do you believe are attractive in the current environment? Those that apply to public sector work will be a little less volatile, number one. And forensic services in terms of environmental services. So, I mean, I'm just speaking for ourselves here, have done incredibly well. And because of the resi work, because of the bounce in the resi work, we saw an initial hit, big hit, with our transactional work, but because of the bump in the resi, we've seen that really come back. And overall, I'm bullish. I'm bullish that this isn't going to be an 08 type of situation. And with that, that draws a conclusion to this presentation. Thank you very much, Chad. I'll turn it back over to you.
Thank you, Bill. Great presentation. And the Vertex story is an awesome one. I encourage you to go to their website, check them out. They've got a big vision, and if you know Zweig Group, we're inspired by big visions. Thank you for joining us. We're going to sign off here. I hope you'll join us for our Elevate Her Symposium immediately following this. You'll have to get out of this and follow the link to the Elevate Her Symposium. Bill McConnell, thanks again so much for your time and expertise today. I know I learned a lot, and I know the rest of our very large audience learned a lot. So everyone have a great day.